Hello and good evening. This is Doc Severson for the ReadySetCrypto OMNIA newsletter market update for Sunday, the 7th of June. Bitcoin versus the US dollar has been very strong today, even. As you can see, this has come down and retested that trend line one more time. So one more time that the bears have failed to get the job done, even though we're consolidating in a declining volume environment, which is actually good. This is what we expect to see. Now, I didn't like this false breakout to the upside the other day, but no harm, no foul. I'm actually very surprised that we didn't tumble much lower after that. I guess if there's a good thing about all the leverage and the liquidations that are happening, it's that the pain gets over with very, very quickly. Now, this is being recorded at 4 o'clock in the afternoon on Eastern time, which is about 4 hours before the market day closes. And we're starting to see a real strong bid here. And this is Agri.trade. And we're seeing this move from 9,500 all the way up to 9,750. So 9,550 up to 9,750, 200-point move. And this has happened in only about 20 minutes. So something is going on here. I wouldn't be surprised to see a slightly higher bid or maybe even an attack at 10,000 one more time, as the price has about 2 hours left to go before the CME futures and options will open up. Let's go ahead and reset the expected move that the market thinks is going to be a 68.2% probability for the range between now and the end of June, which is 26 June is the next big monthly cycle here, which is this red line. And looking at the expected move, which is the at the money straddle of the 26 June options, I have plus minus 1130. And so that's going to put the top end of this range at 10,730. So we'll get that set here. That's pretty close right there. And then the bottom end of this range is 84.70. So we're going to tighten this range up a little bit. So by this range tightening up, that means that implied volatility has come in slightly. So there we go. That's our expected move into the end of June. Let's go ahead and copy this one or clone it and drag this one over to 31 July. There we go. And let's set the expected move for the end of July. Let's go ahead and put an arc in here. And we're going to have the upper end of this be 11,565. 11,565, and it's going to be right around there. And the bottom end of this range is going to be 76.35. 76.35, which is going to be pretty close to about there. And we'll drag that one over, and let's give this one a slightly different background to this. So we'll tell that green. There we go. There's our expected moves into the end of June, into the end of July. None of this appears to be all that surprising. This seems to be a very low volatility cone that we're in. Now, if we add the fractal to this and see how much energy we have, you can see that this is turned into be a linear move off of the last major test of this trend line, where we spent a couple of days loitering around this trend line. And that gave us a nice hook from there. The price has actually gone from about 8,700 up to the current price, about 9,700 or so. So this has been a decent move. It's taken a little energy out, but this consolidation over the last 1, 2, 3, 4, 5 days is allowing it to build back up again. Now, if we go out to the weekly chart, what do we have here? You can see that this is starting to drop off these red candles here, and we're starting to reflect the very linear move because the energy is starting to drop again. And we're in the mid 40s right now. In 4 hours, we'll have a new weekly candle. We'll see what effect that has to this. And of course, let's drop out to the monthly chart. Now, I apologize for all the mess that's on here, but we can kind of see what's going on. especially if we look at the log scale. The log scale is going to give us a better indication of this big energy happening at the monthly chart. And we haven't seen this level of energy since 2014. Since 2014. So it's been about 5.5 years since we've had this amount of potential energy for the market to move. So when people go to sleep in a market, this is typically what happens to this. People just give up and say, well, this market's not moving. There's nothing going on. It's time to go. Let's go chase after another market. And lately, all the oxygen has been pulled out of the room by especially the NASDAQ stocks. So the tech stocks on the major markets have just been booming ever since the pullback, which was an epic crash. But this is the way that the market has treated this. And a lot of this is due to Fed policy. And of course, we had this huge jobs number on Friday. Believe it or don't believe it, it doesn't matter. You can believe the price, though. So this is just about the most wicked V-bottom that I've seen. However, there is a little bit of a curious thing that we see when we pull out to the S&P 500 and we go out to the monthly chart of this. And this is not something that I see very often, but this kind of really sums up what I see with this, is that we're seeing the lows, the major lows, get deeper and lower. So it's a series of lower lows going along, but at the same time, we're getting a series of higher highs. And you can bet that this price up here will eventually pierce into a new high, all-time high. There's so much money just sloshing around the streets right now looking for a home, and this is really the one place that's got any yield to it. This is called a broadening pattern. And a broadening pattern implies instability. It's getting more and more unstable. The volatility is increasing as it goes, which does imply that at some time we're going to have an even greater crash than the one that we saw, which was the worst one that we have seen over the last 91 years. So the crashes will get bigger, the rallies will get bigger. This is part of the broadening pattern. So again, this is the bigger markets are going to be doing this. And unfortunately, cryptocurrency will be kind of held hostage to this. Here's the one other thing that we have to keep an eye on, and this is the 10-year note. So this is what's considered to be the risk-free return that's out there. And right now it's about a 1% return, which is not good, right? This is one of the reasons why everything is going into risk assets. This is one of the reasons why cryptocurrency has held pretty steady over the last several months. Sure, we did get a big drop there, but we're back up near 10,000 again on BTC. Some of the altcoins have started to perk up a little bit. It's not alt season yet. We don't have a major rally yet. We're still held captive in that big pattern that we have. But watch the 10-year note, because if this starts to rise, then we're going to start to see a lot of pressure being put on risk assets again, because people don't like risk. They like these risk-free returns that are sitting up here at 3.2%. But don't forget that when we were up at 3.2%, this was a market that was screaming higher at the time, at least the larger market, not necessarily cryptocurrency. So this is one of these things that where you have to watch out through all the other elements going on. Something else that I've been talking about lately is the dollar index. The dollar index has actually been plunging lately. So for those of you that think cryptocurrency may be an alternate form of currency, you have to wait until people no longer want to buy dollars. So this is just a very small time move. We have to watch this on a weekly chart. Remember rule number 2, reversals start from the inside out. So watch this from the inside out. It's starting to move into a primary downtrend. On the monthly chart, the dollar index hardly seems like it's moving at all. But watch this carefully, because if this starts to fall, then other forms of monetary value will take precedence. That's it for this weekend's report. You guys have a great rest of the evening. We'll see you back here on Monday.